Right now, while you're watching this video, the money sitting in your bank account is losing value. Not dramatically. Not all at once. Quietly. And most people have absolutely no idea what to do about it. Inflation is one of the most misunderstood forces in personal finance. It doesn't announce itself. It doesn't send you a letter. It just erodes your purchasing power, year after year, until one day you realize your savings bought half of what they used to. But here's what the wealthy have always known, and what Wall Street rarely tells you openly. Certain assets don't just survive inflation. They thrive in it. Today, we're breaking down the 6 assets that quietly protect your wealth when prices spiral out of control. Some of these will surprise you. One of them, you probably already own. Let's get into it. Let's start with the one most people know, but few truly understand. Real estate. During the inflation crisis of the 1970s. When inflation hit nearly 15% in the United States, home prices didn't crash. They rose. In fact, between 1970 and 1980, the median U.S. home price more than doubled. Here's the mechanism most people miss. When inflation rises, the cost to build new homes also rises: lumber, steel, labor, permits. That raises the floor on existing property values. Meanwhile, if you locked in a fixed-rate mortgage before inflation hit, you're paying back that debt in cheaper future dollars. The bank takes the hit. You get the asset. That's not luck. That's how the system works. Most people don't realize that real estate is one of the few assets where inflation makes both the debt cheaper and the asset more valuable at the same time. Here's something that sounds almost too simple, but is backed by over 200 years of economic history. Inflation is, at its core, rising commodity prices. Oil. Natural gas. Wheat. Copper. Gold. When the dollar loses purchasing power, it takes more dollars to buy the same barrel of oil or ton of copper. The commodity's real value hasn't changed. The dollar's value has dropped. This is why during every major inflationary period, the 1940s post-war boom, the 1970s oil crisis, the post-COVID price surge of 2021 to 2023, commodity indexes outperformed nearly every other asset class. History shows a pattern: money flows into the things that inflation is made of. Whether you access commodities through physical ownership, ETFs, or energy stocks, this asset class deserves serious attention in any inflationary environment. This one flies so far under the radar that even experienced investors overlook it. Series I savings bonds, issued directly by the U.S. Treasury. Here's what makes them remarkable: their interest rate is indexed to inflation. When inflation goes up, your rate goes up. When the consumer price index jumps 8%, your I-bond adjusts accordingly. During 2021 and 2022, as inflation surged to its highest level since the early 1980s, I-bonds briefly offered a return of over 9% annually. Meanwhile, savings accounts were paying less than 0.5%. The catch? You can only buy $10,000 per year per person. There's a 1-year lockup minimum, and a small penalty if you cash out before 5 years. But for conservative investors who want inflation protection without market risk, this might be the most underrated instrument available to ordinary people. Here's where people get confused. Doesn't the stock market crash during inflation? Sometimes. But not all stocks are created equal. The ones that protect you are companies with pricing power. Businesses that can raise their prices when costs rise, and customers will still pay. Think about it. When inflation hits, companies like Coca-Cola, McDonald's, and major oil producers don't shrink. They pass the cost to the consumer. Their margins hold. Their earnings grow. Their stock prices follow. During the inflationary period of the late 1970s, energy stocks and consumer staples were among the strongest performers in the entire market. The key insight isn't buy stocks or sell stocks during inflation. It's which stocks you own. Businesses with brand loyalty, inelastic demand, and the ability to raise prices are among the most powerful inflation-resistant assets available to the average investor. Most people have never heard of farmland as an investment. They should. Over the last 50 years, U.S. farmland has delivered average annual returns of around 11%, with remarkably low volatility. And during inflationary periods? It consistently outperforms. Why? Because farmland produces food, and food is always in demand. When commodity prices rise, the value of the land that grows those commodities rises with it. Timber operates similarly. Trees grow regardless of what the economy does, and harvesting can be timed to match market cycles. Infrastructure, toll roads, pipelines, airports, utilities, is another category worth understanding. Many infrastructure assets have contracts or regulated returns directly tied to inflation indices. The more prices rise, the more revenue flows through. These aren't just assets for billionaires. REITs and ETFs now offer ordinary investors access to farmland, timber, and infrastructure in the same way they'd buy a stock. What happens next is surprising. In a world of rising prices, owning the physical foundations of the economy may be more protective than any financial instrument. Gold gets mocked by modern investors. It doesn't produce income. It just sits there. They're not entirely wrong. But they're missing the point of what gold actually does. Gold is not a growth asset. It's an insurance asset. And in times of currency debasement, when governments print money, when debt spirals, when trust in financial systems erodes, gold has held its purchasing power across thousands of years of human civilization. During the inflationary spiral of the 1970s, gold went from $35 per ounce to over $800. That's more than a 2,200% return in one decade. Was it perfect? No. Gold can be volatile in the short run. But over long periods of monetary stress, the pattern repeats with almost mathematical consistency. The wealthy don't own gold to get rich. They own gold to make sure inflation can't make them poor.